In this video, I will cover why nuclear energy is an interesting investment opportunity now, what investment vehicles are available for retail investors, what kind of exposures will an investor get by investing in nuclear energy solutions, and last but not least, why consider VanEck Uranium and Nuclear ETF instead of others. Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, or one investment fund per video, to share how an individual investor like you and I can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I am not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the VanEck Uranium and Nuclear ETF. Energy is crucial for the progress of humanity. From the discovery of fire, to fossil fuels, to electricity, to renewables, every new development in energy discovery and utilization marks a major step in the evolution of human civilization. The world population has grown exponentially in the past century, from about 2 billion to over 8 billion by end 2024. And as our lives become more and more complex, there is an insatiable demand for more energy. Technology advancements have helped in improving the extraction of traditional energy mix of coal, oil, and natural gas, but more so in enhancing the developments of more efficient clean energy solutions, from hydro dams to wind farms to affordable solar panels to smaller scale commercialized nuclear plants. As such, while clean energy solutions are not yet optimal enough to replace traditional fossil energy, it is a matter of when, not if. However, as investors, we need to look at investment profitability. While solar and wind energy have been heavily advertised and focused on in recent years, the reality is that developments in these areas have been heavily subsidized by governments. Therefore, while solar panels and wind farms have become more commonly implemented, the companies that produce these solutions have not really been profitable. As seen, the global solar energy industry peaked in 2021 and have been declining since then. The wind energy industry have also exhibited the same, peaking in 2021 and declining thereafter. The main reason for this is that the expectations of these alternative energy solutions have been way too high and have been unrealistic. While they were marketed to replace fossil fuels and save Mother Nature along the way, the reality is that the sun and wind are not consistent energy sources. Technology is not yet advanced enough to drive down enough cost, and the solutions bring about other problems to the environment and ecosystem. Therefore, in the world today, fossil fuels still dominate the energy market, and it is highly unlikely we will see alternative energy taking over the lead in the next decade. But this video is about nuclear energy, not solar or wind. So let's get on topic. Nuclear energy is actually commonly used in many countries. The chart shows Europe being a heavy adopter of nuclear in terms of share of nuclear energy in total electricity generation, while US and Russia have nearly 20%. In Asia, Korea is about 30%, Pakistan 16%, Japan 9%, Taiwan 7%, and China 5%. China in particular is heavily investing in building new nuclear reactors, but works are being done in various other countries globally as well. Not to be left behind, the US also announced in November 2024 an aim to triple the current nuclear energy capacity by 2050. While this was announced under the Biden administration, this does not conflict with Trump's plan for energy dominance. Unlike solar and wind markets, the nuclear energy industry has held up well through the years, exhibiting a generally positive trend even after 2021. The rapid developments in artificial intelligence in the past year has also led to a spike in electricity usage from the data centers, especially those owned by the mega tech companies like Amazon, Google, and Microsoft. As a result, these companies have started to look at small nuclear reactors as a key electricity source. Nuclear energy investments is a niche market. From uranium extraction and enrichment, to storage and fuel fabrication, to construction and maintenance of nuclear reactors, to safety management and handling of nuclear waste. This is a market with extremely high entry level, and therefore there are very few companies involved in each part of the process chain. Given the sensitivity of nuclear power, some of the companies are also government-owned, making the investable market even more limited. Aside from private market investments, the only viable investment vehicles for retail investors are a handful of ETFs. Here are the list of US listed and Europe listed ETFs relating to equity investing for nuclear play. There are also a handful of commodity ETFs focusing on physical uranium play, but I will exclude those for this video. If we remove the leveraged ETFs and those with too small AUM, that leaves us with three main ETF providers that are Global X, Sprott, and VanEck. Using the US ETFs for comparison, the Global X Uranium ETF or URA and the Sprott Uranium Miners ETF or URNM are both focusing on uranium mining companies and therefore tend to be correlated to each other. They are also much more volatile as the share prices of the mining companies are strongly influenced by the uranium commodity price fluctuations. The VanEck Uranium and Nuclear ETF or NLR is more diversified across the nuclear energy supply chain and therefore has been a relatively more stable play in recent years. With this in consideration, the VanEck ETF looks to be a better long-term investment for nuclear play. Interestingly, VanEck has two slightly different ETF versions. NLR is listed in US, while NUCL is listed in Europe, and they each track a different index. I will elaborate on this next. MarketVector is an indexing business founded by VanEck and was renamed from MV Index Solutions or MVIS in 2022. Therefore, you will see some of its indices having MVIS while others having MarketVector in the names. MarketVector differentiates itself from the big indexing players by focusing on thematic plays and lesser covered markets, and is used as a basis for VanEck's ETF business. The Global Uranium and Nuclear Energy Index, or MVNLR, was launched in 2012 and is used as the benchmark for the US-listed VanEck Uranium and Nuclear ETF, or NLR. The Global Uranium and Nuclear Energy Infrastructure Index, or MVNUCL, was launched 10 years later in 2022 and is used as a benchmark for the Europe-listed VanEck Uranium and Nuclear Technology ETF, or NUCL. Market capitalization and liquidity requirements of the companies are the same, though they are both currently only having 25 stocks in the index, so it is rather concentrated. However, as mentioned previously, the nuclear energy market has few players due to the high cost of entry, so it is better for the index to keep it clean rather than to add in less relevant stocks just for the sake of increasing the component count. The key differences between the two are that MVNLR has broader exposure, while MVNUCL has a deliberate focus on infrastructure. MVNLR also has a component size limit of 8%, while MVNUCL is 15%, so that implicitly makes MVNLR having a lower concentration risk. This leads to a big difference in the underlying component exposures. Looking at top 10 positions, MVNLR is a bit more diversified and has more US energy providers and utilities companies, such as Constellation Energy and PG&E, while MVNUCL has more uranium miners and nuclear plant manufacturers, such as chemical and IHI. The sector exposure shows this clearly, again, with one focusing more in utilities, while the other focusing more in industrials. And as well in the country exposure, where MVNUCL has over one-third in Canada, since Canada is one of the handful of countries with uranium deposits, and Chemical is the leading mining company in Canada. Performance-wise, it is easier to use the representing ETFs for comparison. Here, we have the green line, which is the US-listed NLR, and the red line, which is the Europe-listed NUCL. NUCL has only about 2 years of track record, but NLR has over 10 years. So we can compare NLR against global equity using a MSCI World ETF in the yellow line, and a global energy sector ETF in the blue line. As seen, energy sector has been a laggard compared to the broad global equity market, but NLR has been much more stable than energy sector and has outperformed significantly in the past 2 years. Zooming in on past 2 years to better compare the two VanEck ETFs, we can see that both ETFs have been quite similar in returns, with NUCL doing slightly better in the past few months. Both ETFs have also substantially outperformed the energy sector ETF and even outperformed the MSCI World ETF. After browsing through the two indices, my views are that the choice is primarily dependent on whether to have more focus on US utilities and energy providers, or more focus on uranium miners and infrastructure play. In consideration of the new Trump administration and the impending changes it may bring forward, I think MVNLR might be a better pick at this point. MVNLR does have a slightly weaker performance in the past 2 years, but it also has a much longer established track record that has shown the stability of the index construct. The 8% size cap on the components also helped to reduce concentration risk, which is better for long-term investments. So that means we will look at the US-listed VanEck Uranium and Nuclear ETF, or NLR, in more details next. VanEck is a US-based asset management firm founded in 1955 by John VanEck. VanEck has since the start been a thematic investment player, focusing on identifying new investment themes in the market and taking the lead to launch associated investment products, from gold investing to emerging markets to digital assets. VanEck today manages over $110 billion worth of assets across all types of asset classes, with equities slightly over half of the assets. VanEck is best known for its ETF business, primarily US listed, but also in the recent years been expanding its Europe UCITS offerings. Besides ETFs, VanEck also provides to a smaller extent other mutual funds and private fund solutions, as well as other investment solutions. Having already explained the index earlier, the VanEck Uranium and Nuclear ETF, or NLR, is quite straightforward. The ETF also provides a description that is clearer than the index, which states it will invest in companies involved in one of the 4 aspects of nuclear energy ecosystem, from uranium mining to nuclear plant construction and infrastructure, to electricity production, and finally to equipment, technology, and service provision. NLR was incepted in 2007, giving it nearly a 20-year track record. It currently has over $900 million of AUM and is listed in the New York Stock Exchange (NYSE). It is traded only in US dollars. NLR charges a 0.5% management fee, with the total expense ratio coming to 0.61%. While it is a little higher than the usual Vanguard and Spider ETFs, this is a thematic focused product. Therefore, it commands a little more fees. Portfolio construct of NLR is similar to the index. Given there are less than 30 positions, actual implementation timing and liquidity requirements will lead to some small deviations. One thing to note is that NLR pays out a small distribution annually. The amounts tend to vary, but do consider withholding tax impacts, which will shave off total annual performance a little bit. On performance, while it was already covered earlier when comparing the different ETFs, here is a calendar year performance chart, which nicely shows that NLR has had positive yearly returns since 2016, which differentiates it from the typical global equity exposures and making it potentially a diversification candidate in equity investment portfolios. With that, let's summarize our findings. The main thesis for nuclear energy now is threefold. Firstly, nuclear is a more stable and consistent alternative energy source than solar and wind, and now has the opportunity to stand out after the world spent the last few years aggressively trying out solar and wind solutions. Secondly, the rapid developments of artificial intelligence in recent years have led to high growth in data center business and high demand for electricity. As such, these tech companies are now starting to invest in nuclear energy solutions to meet their electricity requirements. Thirdly, with Trump's return as US president, one of his key focus is on energy dominance for the US. While the plans are primarily focused on the oil and gas segment, nuclear energy can help to complement and contribute toward this objective. The VanEck Uranium and Nuclear ETF (NLR) is one of the few investment vehicles available in the market for retail investors to participate in nuclear energy investments. Most other vehicles tend to have a high focus on uranium mining companies, while NLR has a more diversified portfolio with investments through the whole nuclear energy ecosystem. This makes it a more suitable pick for long-term investing. NLR has a long track record since 2007, and performance in the past decade has been decent, with positive calendar year returns since 2016. Past 2 years have also been better than MSCI World and Global Energy Sector. NLR is US listed and offers trading only in US dollars. It has a small annual distribution payout, which means global investors will have to factor in withholding tax impacts when calculating performance. All in all, NLR looks to be a decent pick for a nuclear energy thematic play. This concludes my absolutely biased comments on the VanEck Uranium and Nuclear ETF (NLR). If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.